In the next few days, something is going to happen at the COMEX that the silver market has not seen at this scale in years. First notice day is approaching, and for the first time in a long time, the number of contracts standing for physical delivery is dangerously close to exceeding the registered silver available to meet them. If you don't know what that means yet, you need to, because what plays out in the next 2 to 3 weeks could trigger a price move that catches the majority of investors completely off guard. This is your warning. Welcome back. For those of you who follow this channel regularly, you know we don't raise alarms lightly. Every claim we make is grounded in data, open interest figures, registered inventory levels, warehouse receipts, and the kind of structural market analysis that most retail investors never see. Today's video is one of the most time-sensitive we've published. We are going to walk you through exactly what first notice day means, why this particular delivery cycle is uniquely dangerous for paper silver holders, what the registered inventory data is screaming right now, and what 2 to 3 possible outcomes look like for the silver price in the coming weeks. By the end of this video, you will understand this market better than 90% of people who trade it. Stay with us. Do not skip ahead. Let's start with the mechanics, because if you don't understand the plumbing, you can't understand the pressure building inside the pipes. COMEX, silver futures contracts, are agreements to buy or sell a fixed quantity of silver, typically 5,000 troy ounces per standard contract, at a specified future price. The vast majority of these contracts are never settled with physical metal. They are closed out before delivery, rolled forward, or cash settled. That is the normal functioning of a futures market. But first notice day changes everything. First notice day is the first day on which a seller holding a futures contract can issue a delivery. Notice, formally declaring their intention to deliver physical silver. Once that notice is issued, the buyer must accept delivery or exit the position. This creates a critical window, typically the last 5 to 7 trading days before first notice day, during which speculators and funds who are long paper silver but have no intention of accepting physical delivery must close or roll their positions. In normal market conditions, this rollover happens smoothly. Longs exit, new contracts replace them. The cycle continues. But here's what almost nobody is telling you. This delivery cycle is not normal. To understand what's happening, you need to know the difference between 2 types of silver sitting in COMEX-approved warehouses. Eligible silver is metal stored in approved vaults, but it belongs to private owners who have not yet made it available for futures delivery. Think of it as silver in a warehouse that hasn't been listed for sale. Registered silver is the metal that has been formally made available for futures delivery. This is the only silver that actually counts when a contract demands physical settlement. Now here are the numbers that matter. Registered silver inventories at COMEX have been in structural decline. We are now at levels that, when compared against the open interest remaining in the front delivery month, produce a coverage ratio that should make every paper silver holder deeply uncomfortable. When the number of contracts standing for delivery approaches, or threatens to exceed, the registered silver available to meet them, one of 3 things must happen. Either registered silver is rapidly converted from eligible stock, or contract holders are persuaded to cash settle rather than take delivery at a premium, or the price must move sharply higher to incentivize new physical supply into the registered category. Now, pay attention, because this changes everything. In the current environment, with physical silver demand running at multi-year highs due to industrial consumption, solar panels, EVs, advanced electronics, the pool of eligible silver that owners are willing to convert to registered is smaller than the headline eligible number suggests. This is not a theoretical concern. This is the mathematical setup that exists right now. This delivery mechanics story does not exist in isolation. It is being supercharged by a macro environment that has fundamentally changed the supply-demand equation for physical silver. The Silver Institute's most recent data confirms that global silver demand reached near record levels, driven almost entirely by industrial applications. Solar panel manufacturing alone now consumes over 20% of annual global silver mine supply. And that figure is rising, not falling, as European nations accelerate their renewable energy targets. Meanwhile, global silver mine supply growth has been essentially flat for several years. New mine development is slow, expensive, and constrained by energy costs, permitting backlogs and geopolitical complications in key producing regions like Mexico and Peru. This is what the big banks don't want you to focus on, because the simplest supply and demand analysis applied to physical silver tells a story that is deeply uncomfortable for institutions running large, short positions in the paper market. Add to this the macroeconomic backdrop, the European Central Bank managing an economy caught between sticky inflation and weak growth, the U.S. Federal Reserve under political and fiscal pressure that limits its true flexibility, the dollar under long-term structural pressure as BRICS nations accelerate de-dollarization and accumulate gold and silver reserves, Every one of these macro forces is a tailwind for physical silver. And right now, all of them are converging with this specific time-sensitive COMEX delivery event. The setup has never been more concentrated. Here is where the technical data becomes genuinely alarming. In a normal delivery cycle, we would expect to see open interest in the front month contract declining steadily in the week to 10 days before first notice day. Longs roll forward. The open interest migrates to the next contract. The system resets. That pattern this cycle is not playing out the way it normally does. Open interest in the delivery month has remained stubbornly elevated. The roll is happening more slowly than historical norms, and this is critically important. A portion of the remaining long open interest represents entities that have the financial capacity to take delivery and may have every intention of doing exactly that. When you cross-reference the pace of the roll with the current registered inventory level, the coverage ratio, contract standing versus ounces available, is tighter than at any comparable point in recent memory. Now, does this mean the COMEX will default or fail to deliver? Almost certainly not. The exchange has mechanisms, emergency inventory conversion, cash settlement premiums, position limits that prevent outright failure. But here is what does happen in a genuine physical squeeze. The price becomes the release valve. When registered inventory cannot comfortably meet delivery demand, the spot price must rise to the point where it incentivizes sellers to convert eligible metal, or where it makes cash settlement economically attractive to longs. In either case, the price moves sharply higher in the near term. That is the technical trigger we are watching right now in real time. Let's run 3 scenarios for what happens between now and the resolution of this delivery cycle. Scenario 1, the delivery squeeze. A meaningful percentage of remaining longs stand firm and demand physical delivery. Registered inventory proves insufficient to meet demand without significant price incentive. The silver spot price spikes sharply, potentially $5 to $10 in a compressed time frame, as the market reprices to attract physical supply. In this scenario, any silver holder who is positioned before the spike captures extraordinary short-term gains. More importantly, a successful large-scale delivery event at this inventory level would send a structural signal to the broader market that the COMEX paper-to-physical ratio is under genuine stress. This is the scenario that dedicated silver watchers have been anticipating for years. Whether it arrives now or in a future cycle, the setup has never been closer. Scenario 2, the orderly roll with a premium. Most longs roll forward, but do so at a measurably higher roll premium than recent cycles. Spot. Silver drifts upward, $2 to $4, as the tighter than normal registered inventory creates friction in the rollover process. This is the most likely near-term outcome. It is less dramatic than scenario 1, but it is still bullish for silver holders. A higher roll premium is the market's honest admission that physical silver is becoming harder to source at these prices. And critically, it sets up the next delivery cycle in a few months, with even greater potential stress if the structural deficit continues. Scenario 3, the paper retreat. Institutional longs with leveraged positions are forced to exit aggressively as margin conditions tighten or risk managers intervene. Open interest collapses in the final days, before first notice day. Silver pulls back toward the $72 to $74 support zone. In this scenario, the delivery pressure dissipates, but only temporarily. The structural supply deficit doesn't disappear. The macro tailwinds don't reverse. What you get is a short-term dip that, in the context of the longer-term thesis, represents a buying opportunity rather than a trend change. In all 3 scenarios, the medium-term direction for silver remains higher. What changes is the timeline and the entry point available to investors who are paying attention. Let's bring it together, because the clock is genuinely ticking here. The COMEX is approaching a first notice day for silver with registered inventories at critically low levels relative to the open interest standing for delivery. Physical demand from industrial users is at multi-year highs. The macro environment, dollar weakness, ECB credibility under pressure, continued BRICS gold and silver accumulation, provides deep fundamental support beneath the technical picture. The 3 scenarios we've laid out range from a sharp near-term squeeze to a temporary pullback. But in every single scenario, the structural bull case for physical silver remains completely intact. The investors who benefit from events like this are not the ones who react after the move. They are the ones who understand the mechanics before it happens. You now understand the mechanics. Well, what you do with that information is your decision. But time in this particular situation is genuinely limited. If this analysis was useful to you, and if you want early warning on the next major silver and gold market event, subscribe right now and turn on the notification bell. We will be following this delivery situation in real time and publishing updates as the data changes. Comment silver below if you believe this delivery squeeze is the real deal. Comment wait if you think the longs will roll and the pressure dissipates. The debate in the comments on this one is going to be worth reading. And our next video, dropping very soon, covers exactly what the smart money is doing with gold positioning right now and why the ECB's next move could accelerate everything we've discussed today. Don't miss it. We'll see you there.